We just got into a lengthy discussion of what a squeeze is, and now we're going to talk about a freeze. And Trevor, I want to lay out this hypothetical of this particular client. This would be a husband and wife, and let's just say they have a total net worth of $100 million. And that 100 million, and I'm just do that, make my math easier, right, Trevor? But we do have a lot of clients that are worth 100 million plus. But those particular clients, they'll usually have it's interesting to me that sometimes these clients are real estate driven, and 80% of the portfolio is real estate. They might be stocks and bond driven, 80% stocks and bonds. But these concepts we're talking about, it doesn't really matter what the asset is. We work with value. The asset may be a value of a business, right? So we talked about earlier in our squeeze video where with this $100 million client, he's going to be able to squeeze, probably 40 million, maybe 45 million into the exemptions between him and his wife. We know the exemptions about 13.6 million a piece. Let's just call it 27 million a husband and wife can give away. In the squeeze we talked about with valuation discounts, the amount we're giving away could be in that $40 million range, right? So we're off to a pretty good start. $100 million client. We did the squeeze technique. We've got 40 million into a green box. We're off to a good start. Now, a lot of people would say, well, that's all you can do. You used up your exemption. There's no more gifting. Go home and just get ready to pay the IRS a big check. But we don't say that, do we, Trevor?
No, we don't like writing those checks.
No. We developed the concept, we call it a freeze. And there again, this is a term that we developed, and it's a term that embodies a couple of complicated strategies that we're going to talk about here. We're going to talk about these two main strategies. We're going to talk about, selling assets to a green box with an intentionally defective green box. So this strategy, you can Google it, it's called an installment sell to an intentionally defective grantor trust. Trevor, what's the acronym for that?
We call it an IDGT.
An IDGT.
IDGT, yeah.
A lot written out there on this. I mean, we didn't make up the IDGT, but we understand it.
Right.
Right? And then kind of the twin sister to the IDGT is a GRAT, the Grantor Retained Annuity Trust, the GRAT. And we're not going to talk a lot about the GRAT here because we think the IDGT's a lot better, so we're going to spend our time talking about an IDGT. But I'm going to tee it up for you, Trevor, this way. So IRS, after you have used up all your exemptions, it is true you can't gift anymore without paying a gift tax. That is true. But what the IRS is very, very lenient on is I can give away future appreciation in value tax-free. Now let's let that soak away. I'm telling you, you can give away future appreciation in value tax-free. So how long do you think it's going to take this $100 million client, Trevor, to be a $200 million client? How long do you think that's going to take?
Yeah, in our experience, it's 7 to 10 years. Yeah. They're going to double.
It's quick,
it's
isn't
quick,
it?
Yeah.
The more wealth somebody has, it doubles and triples much quicker. And I think everybody's familiar with the rule of 72. But with the rule of 72, when you're dealing with these bigger numbers, an average guy, if he gets an annual rate of return of 6 to 7%, they're thrilled. With these guys, with their kind of wealth, they don't seem happy unless they're getting into the 20 to 25% rate of return. Right. So their wealth does double and triple very quickly. And we're not going to just sit back and watch them go from 100 million to 200 million and watch their problem get worse. We're going to implement the freeze. And the freeze is going to allow that growth from 100 to 200. That next 100 million, it's going to allow it to be in a green box, tax-free. Is that what we're saying?
That's what we're saying.
All right, tell me how to do it.
So, that's exactly why we call it the freeze. We're going to freeze the value that's counted in the client's estate, right? And so what we're going to do is we're going to use our friend, the family limited partnership, and we're going to have a limited partner interest or a non-voting interest, and then we're going to have our client sell a limited partner interest to one of these green boxes.
He's not gifting it.
Not gifting.
We're not using exemption.
We're
not
did
reporting.
That. We already used the gift tax exemption. And
so he can sell assets to a green box.
But he can sell it, and that's where we pair the greatest tool, that limited partnership of all time, with the greatest revenue ruling of all time for
There
estate
you
tax
go.
purposes.
Going to get to the rat. And
Yeah, we might not mention the RAP.
go ahead. I'm going to let you give me a
So,
code section, a revenue
We're
ruling.
going to throw out revenue ruling 85-13.
All right.
And 85-13 says that a client can sell a piece of their, some of their assets, so this limited partnership interest, to an irrevocable defective grantor trust, that IDGT, without triggering any capital gains tax.
Okay, let me get this straight. So you're creating a green box for estate tax purposes is taking assets out of the estate, and you can't give to that trust, but you can sell assets. Now I'm a CPA, Trevor. You're not going to trick me here.
No tricks.
When I sell assets, I'm triggering capital gains. Why not here?
That's the default rule. When you sell assets, you trigger capital gains. But in Revenue Ruling 85-13, the IRS said that client that's making that sale is treated as the owner of the assets that are inside that green box, inside that grantor trust. And so it's like he's selling those assets to himself. And the IRS said, well, if you're selling assets to yourself, that's not a real transaction.
So you have a trust that's recognized for estate purposes, but doesn't exist for income tax purposes.
That's why we call it defective. And clients sometimes raise their eyebrows when they hear that word, and we say, don't worry, the trust is very effective for this estate tax freeze that we're wanting to accomplish, but it is defective for income tax purposes, meaning it's ignored. And so it doesn't give any income tax benefit. There's no income tax downside, including when you sell assets to that trust, there's no trigger of capital gains.
What a country.
What a country.
Okay, now, where does the freeze come back to play then? So what does he have in his estate when he dies?
So because it's a sale, that trust, it might not have $100,000 to pay right now to the client. And so what happens is our client takes back a promissory note.
Yeah.
And so it's an IOU where it says that defective grantor trust owes $100 million to the client.
Yeah, in our example, we've given away $40 million on the squeeze. Let's talk about doing another $40 million on the freeze.
So we're selling $40 million. The IOU says the trust owes $40 million back to the client. And that we amortize it, or maybe it's interest only, but we make it a regular promissory note, and that promissory note is going to start shrinking in value instead of appreciating.
And that's in the red box.
And that's in the red
freeze.
box. That's the freeze. We've got the appreciating growing assets in the irrevocable trust.
The next $40 million.
And they're going to grow in value, double from 40 to 80 million and 80 to 100 million someday. But what's happening in the red box is that promissory note is being paid down and it's shrinking in value over time.
Yeah, it's a great technique. And then back to what you're saying, this is the installment sale to an intentionally defective grantor trust, the IDGT.
Right.
Phenomenal strategy. And Trevor, what would you say is the risk level in this strategy?
You know what, it used to be higher, but over the years, these types of transactions have been challenged in tax court. And so these are strategies where we can go to clients and say, we're fairly confident that if we structure it properly, and when we analyze those cases, we see what works and what doesn't work, and so we implement what works with our clients, then we can tell a client, this is a good sound strategy, and as we implement it properly, then we've got a lot of confidence that it's going to work right.
Yeah, and you hit the nail on the head. The payment back to the client, we need to match that with the income the assets are going to generate, and then we can have that flow into the green box and then out to the client. And generally speaking, whether we make that a 20-year note or a 15-year note, what interest rate we put it, and what interest rate we put is really immaterial, because we said for income tax purposes it doesn't exist.
Right.
Okay, Trevor, on this freeze technique, so the example we're using in the squeeze, we gave $40 million to a green box, and we got that down into the exemptions. Now we're talking about in the freeze, we sold $40 million to a green box. You took back a promissory note for $40 million. So the next day after we've done this, you could argue we haven't really done anything to shrink the estate further, although we would argue, yes, we have, because we're using discounts and valuations, and so we're getting the squeeze. We're using a squeeze on the freeze as well, right?
That's right.
We're selling $40 million to this trust. That's what we report to the IRS, but really on paper we might be selling 50 or 60 million, right?
That's right.
And now I've got $80 million in this green box, and those 80 million, that's stocks and bonds and real estate, and it's generating revenue. Who pays the income tax on that green box?
Yeah, so our client pays that tax. So the person who sold the assets to the trust or who gifted the assets to the trust continues to pay the income tax on it, which is a good thing, right? Because we're doing these transactions because the client has too much wealth. They're above these exemption amounts. And so as we allow the assets in that trust to grow even income tax free because the trust doesn't have to pay that tax, our client pays that tax, and as they pay that tax, their red box shrinks as they write checks to the IRS, and it doesn't change the amount of tax that's going to be paid, and so it's a good result from an estate tax standpoint to have the client continue to pay tax on that.
Well, the client's got the money to pay the tax because he's getting the payment on the promissory note, and the payments on the promissory note replicates the income he's lost. And I'm gonna put that in as the last advantage of a freeze technique, because in most of these trusts that we set up, one of the forbidden fruits is you can't create a trust, transfer something to that trust, call it a gift, but still retain an economic benefit. You can't retain the income and the use and enjoyment. Well, here we really can. We create the green box, we sold assets to it, we didn't retain an interest, we sold assets, we've got the promissory note coming back.
Right.
So I think it's the best of all worlds.
It is.
Thanks, Trevor. I think I understand it now.
Wipe the drool off the table.
All right, have a good day.